Welcome to the discussion. Today we're diving into a Dimensional Fund Advisors paper that explores the hidden costs of index investing, specifically focusing on index reconstitution. It's a topic that often gets overlooked, but as we'll see, it can significantly impact returns.
Precisely. Many investors assume index funds are passively managed and therefore low cost, but the reality is more nuanced. The process of adjusting an index's composition or reconstitution introduces several often unseen costs.
And these costs aren't just about fees, are they?
No, they're primarily about market inefficiencies exploited by the very act of reconstitution.
So let's unpack this. What are the key cost drivers associated with index reconstitution?
One category is portfolio design. Index funds, by their nature, often ignore information about differences and expected returns across securities. They simply replicate the index's weighting, regardless of individual stock valuations.
So they might hold underperforming stocks simply because they're part of the index?
Exactly. Then there's portfolio management. Infrequent rebalancing and a failure to utilize short-term information can lead to style drift, further impacting returns.
That is sense. It's not just about the initial construction of the portfolio, but also the ongoing management.
And finally, there are trading costs. This is where the bulk of the hidden costs lie, particularly around reconstitution events. The simultaneous buying and selling of large quantities of stocks creates significant price pressure.
Can you elaborate on that price pressure? How does it manifest?
Our research shows that additions to an index tend to see their prices rise before the reconstitution and deletions fall before they're removed. This is because funds anticipate the changes and start trading ahead of the official announcement.
So you're saying it's a predictable price movement around these events?
Yes, our analysis of 10 major U.S. indices over a decade reveals an average cumulative excess return of around 4% for additions and deletions in the 20 days leading up to reconstitution. This is followed by a reversal of about 5.7% in the 20 days after.
That's a significant swing. And what about trading volume?
Trading volume spikes dramatically on reconstitution day, sometimes increasing by up to 25 times the average volume 20 days prior. We even looked at high-frequency data to see the price pressure in the closing auction, finding significant price movements in the final seconds of trading.
The high-frequency data must have provided some fascinating insights.
It did. We found that prices for additions move up sharply in the closing auction, and prices for deletions move down, with reversals the following morning. This shows the immediate impact of this concentrated trading activity.
So the rush to buy and sell creates these short-term price distortions.
Precisely. And these costs are baked into the index returns, not readily apparent to the average investor. Index providers try to mitigate some of this by designing indices with overlapping boundaries and buffers, but this often leads to unintended style drift.
So there's a trade-off between minimizing tracking error and minimizing trading costs.
Exactly. A better approach would be to spread turnover across all trading days, using daily market information and avoiding the concentrated trading pressure of reconstitution days.
This sounds like a more efficient and potentially more profitable strategy.
It is. By spreading out the trades, you avoid the price pressure and can focus on stocks with higher expected returns. It's about being more flexible and less constrained by the index's rigid schedule.
It's a fascinating argument for a more dynamic approach to index tracking.
Despite efforts to mitigate the effects, our research shows that these trading volume spikes and price pressures are still prevalent. The argument that the index reconstitution effect has disappeared is simply not supported by our data.
So the problem persists, even with the efforts of index providers. What are the key takeaways for investors who are considering index funds?
Investors to be aware that the simplicity and low expense ratios of index funds often mask significant trading costs, particularly around reconstitution events. These costs can materially impact long-term returns.
So it's not just about the stated expense ratio.
Exactly. Understanding the mechanics of index reconstitution and its impact on returns is crucial for making informed investment decisions.
It highlights the importance of looking beyond the surface-level metrics. So in essence, while index funds offer diversification and low expense ratios, investors need to be aware of the hidden costs associated with index reconstitution.
Absolutely. The research suggests that a more flexible daily rebalancing approach could potentially mitigate these costs and improve returns.
It's a compelling argument for a more nuanced understanding of index investing. Are there any areas where you see further research being needed in this field?
Further research could explore the optimal frequency of rebalancing and the development of more sophisticated trading algorithms to minimize price impact. Also, a deeper dive into the impact of different index methodologies would be beneficial.
That's certainly food for thought. This has been a really insightful discussion. Thank you for shedding light on the often overlooked costs of index reconstitution. It's clear that investors need to be more aware of these hidden costs to make truly informed decisions.
You're welcome. It's a critical aspect of index investing that often gets overlooked.
That was a great discussion.